Most traders chase breakouts and patterns, blindly following the crowd into traps set by the composite operator. But what if I told you the highest probability setups occur when institutional money is silently accumulating while retail traders panic? The volume tells a story the price bars won't. Learn to read the tape like the professional money does, and you'll never see the market the same way again. For example, when a stock tests support on decreasing volume after a prolonged markdown, while the masses are selling in fear, smart money is quietly absorbing shares. This absorption phase, invisible to chart pattern traders, creates the spring that launches sustained markup campaigns. The composite operator's footprints are everywhere. You just need to know where to look. The market, my friend, operates on a principle as immutable as the laws of physics. Effort must produce result. When you push against a heavy door with great force, it swings open. That is natural law. But what if you pushed with tremendous effort and the door barely budged? You would immediately know something is wrong. Someone on the other side is pushing back, or the door is blocked. The stock market works identically. Price represents the result, and volume represents the effort. When these two elements are in harmony, heavy volume producing wide price spreads, the market is behaving naturally. But when they diverge, when effort fails to produce the expected result, you have discovered the footprints of the composite operator. Let me be perfectly clear. The composite operator represents the combined activities of the large professional interests who have the power to influence market movements. These are the banking houses, the large operators, the institutional interests who move real money. They cannot hide their activities entirely because moving substantial positions requires volume, and volume leaves evidence on the tape. Consider a stock in a downtrend that suddenly receives heavy selling pressure, perhaps twice the average daily volume, yet closes unchanged or even higher. What does this tell the trained observer? The natural result of such selling should be sharply lower prices. When this doesn't occur, only one logical conclusion remains: someone with deep pockets is absorbing every share the public throws at the market. This is accumulation in its purest form. The amateur trader sees the heavy volume and fears further decline. He sells into what he perceives as weakness, but the professional recognizes this as stopping volume, the climax of selling pressure that exhausts the supply. The effort has failed to produce the expected result because smart money is buying. Now consider the inverse situation. A stock rallies on increasing volume. This appears bullish to the untrained eye. But observe closely. If the price spread narrows despite heavy volume, if the stock struggles to advance even as buying pressure intensifies, you are witnessing distribution. The composite operator is quietly unloading shares to the eager public. The effort fails to produce result because supply is overwhelming demand at these levels. This principle applies at every degree of trend, on the daily chart, on the weekly chart, even on the intraday tape. Train yourself to constantly ask, is the volume producing the appropriate price movement? When you find divergences, effort without result, you have identified the most valuable information in the market. The beauty of this analysis is its objectivity. You need not predict, hope, or guess. You simply observe what is happening versus what should happen. The tape tells the truth. Price and volume are the only two facts in this game of speculation. Everything else is opinion. Master this fundamental law, and you will see through the fog that blinds the masses. You will recognize high-quality setups not by patterns or indicators, but by reading the language of the market itself. After years of studying the tape and observing the methods of the most successful operators, I can tell you with absolute certainty the very best trade entries occur at points of maximum deception. The composite operator does not announce his intentions. He does not ring a bell at market bottoms or tops. Instead, he engineers moves specifically designed to shake out weak holders and trap the uninformed. This brings us to two of the most powerful phenomena in market analysis, the spring and the upthrust. These are the terminal shakeouts, the final acts of deception before significant moves in the opposite direction. Let me explain the spring first, as it occurs during accumulation and represents one of the highest probability buying opportunities you will ever encounter. Picture a stock that has been building a trading range after a decline. Support has been tested multiple times. The public sees this base and many believe the worst is over. Then suddenly price breaks below support, violating what appeared to be a solid floor. What happens next? Panic. The late buyers who purchased near support now sell in fear. The bears, seeing their thesis confirmed, pile on with short sales. Stop loss orders are triggered. Volume often increases sharply. To the amateur, this looks like the beginning of a new downward leg. But here is the critical observation: if this breakdown occurs on relatively low volume compared to previous selling waves, and if price quickly reverses back above support within 1 to 3 days, you have witnessed a spring. What has actually occurred? The composite operator has executed a brilliant maneuver. He has shaken the tree one final time, forcing weak holders to surrender their shares at the worst possible moment. Those shares are absorbed by strong hands. The spring serves a dual purpose. It removes potential supply that could interfere with the coming markup, and it traps short sellers who must buy back shares at higher prices, providing additional fuel for the advance. The key distinguishing feature of a genuine spring is the volume behavior and the speed of recovery. A true spring shows the operator has complete control. He can push price below support, yet demand is so strong that price immediately snaps back. This is not a breakdown, this is a bear trap. Now consider the upthrust, which occurs during distribution and represents the inverse phenomenon. After a stock has enjoyed a substantial advance and has been trading in a range near the highs, price suddenly breaks out above resistance. The public becomes excited. This looks like a continuation of the uptrend. Breakout traders rush in to buy, but observe the volume and subsequent price action. If the breakout produces an upthrust, where price pierces resistance only to immediately fall back into the range, the composite operator has executed his final distribution. He has sold shares to the eager late comers at elevated prices. The upthrust often occurs on climactic volume, as the last burst of public enthusiasm provides the liquidity needed for large interests to complete their exit. These terminal shakeouts, springs and upthrusts, represent the highest quality trade setups because they occur at points where the composite operator reveals his hand through price action that defies public expectation. Learn to recognize these phenomena, and you position yourself alongside the professional money rather than against it. The greatest mistake made by the speculating public is their obsession with immediate action and quick profits. They see a stock moving and immediately want to jump aboard, fearing they will miss the move. This is precisely backwards. The professional operator thinks in terms of campaigns, not individual skirmishes. He understands a fundamental truth that escapes the amateur. Substantial movements require substantial preparation. This is what I call the law of cause and effect, and it is absolutely essential to identifying high-quality trade setups. Let me state this plainly: before a stock can advance significantly, accumulation must occur. Before it can decline substantially, distribution must take place. The accumulation or distribution phase represents the cause. The subsequent price movement, the markup or markdown, represents the effect. And here is the critical point: the extent of the effect is directly proportional to the size of the cause. Think of it this way: a large institutional operator wants to establish a position of 1 million shares. Can he simply enter the market and buy 1 million shares at once? Of course not. Such action would drive prices sharply higher, forcing him to pay increasingly higher prices for his position. Instead, he must accumulate gradually, buying when the public is willing to sell, absorbing supply patiently over weeks or even months. This accumulation period creates a trading range, what appears to the casual observer as dull, sideways price action. The public loses interest. They seek excitement elsewhere. But the professional recognizes this congestion area as the building of cause. He measures the width of the trading range and the duration of time spent in accumulation. A stock that trades in a range for 3 months is building far more cause than one that consolidates for 3 weeks. Why does this matter? Because the cause must be worked off through the effect. A small amount of accumulation can only produce a modest advance. But a large, well-developed accumulation zone, characterized by proper phases of stopping action, testing, and signs of strength, can fuel a substantial markup campaign. This is why the highest quality setups require patience. You do not enter during Phase A when preliminary support appears. You do not enter during Phase B while the cause is still being built. You wait. You observe. You allow the composite operator to complete his work. Only when you see clear signs of strength in Phase C, perhaps a successful spring, and then a definitive break above the trading range in Phase D, do you take your position. By entering at this point, you are no longer guessing. The cause has been built. The operator has committed his capital and resources to this campaign. Your risk is defined by the established support within the trading range, and your potential reward is proportional to the size of the cause that has been created. The amateur chases the effect. He buys during the vertical advance and wonders why he gets shaken out on normal reactions. The professional positions himself during the late stages of cause, building, and enjoys the entire effect with the composite operator rather than against him. This is position trading in its purest form, aligning yourself with the preparation of the professional interests, entering only when the campaign is ready to begin, and holding through the logical conclusion of the move. Patience during the cause yields profits during the effect. Here is a truth that will save you countless losses. A price pattern means nothing in isolation, absolutely nothing. I have watched thousands of traders fixate on individual formations, a triangle here, a breakout there, without the slightest consideration of where that pattern appears within the larger market structure. This is like examining a single sentence without reading the paragraph, the chapter, or understanding the entire book. Context is everything in market analysis. The same exact price, volume behavior can signal a buying opportunity in one phase and a selling opportunity in another. Let me illustrate this point with absolute clarity. Suppose you observe a test on low volume where price probes downward and then rallies. Sounds bullish, doesn't it? But ask yourself, where are we in the market cycle? If this test occurs during Phase A, the initial stopping action after a prolonged decline, it may simply be preliminary support. The downtrend might not be finished. The composite operator may merely be stabilizing the market before allowing further decline to complete his accumulation at even lower prices. But if that identical test occurs in Phase C, after a well-developed trading range has formed, after multiple tests have built a strong support foundation, now you have something entirely different. This is a spring or a final test before markup. The context has transformed the same technical action from questionable to high probability. Consider another example, a strong rally on increasing volume. The amateur sees this and immediately thinks, bullish! But where does this rally occur? If we are in Phase D of accumulation following a successful spring with price breaking out of the trading range, then yes, this sign of strength confirms the operator is beginning his markup campaign. Buy with confidence. However, if that same rally occurs during Phase B of distribution, after the stock has already enjoyed a substantial advance and is now churning in a range near the highs, this rally may be nothing more than an upthrust in the making. The composite operator is unloading shares into public enthusiasm. The exact same price-volume behavior now signals danger rather than opportunity. This is why I insist my students must first determine, are we in accumulation, markup, distribution, or markdown? Only after answering this fundamental question can you properly interpret individual price movements. You must rid the background, understand the position of the market within its larger structure. Think of the market as having a memory and a trajectory. What happened before matters. How long has the stock been advancing? How extended is it from its base? Has sufficient cause been built to justify the current effect? Is the character of the price action showing strength or weakness relative to the broader market? I have seen traders attempt to short a stock simply because it showed a bearish pattern, completely ignoring that the stock was emerging from a year-long accumulation base with massive cause built up. They were correct about the pattern but utterly wrong about the context. The result? Losses. Conversely, I have watched traders buy breakouts during obvious distribution, seduced by the appearance of strength without recognizing the background of topping action. Climactic volume and weakening price behavior on rallies. Master the phases. Understand the cycle. Read the background. Only then can you properly evaluate whether a setup represents genuine opportunity or elaborate trap. If I could impart only one lesson from my decades of market observation, it would be this: learn to read the volume. Price captures the imagination. Everyone watches price, talks about price, makes decisions based on price. But volume tells you the truth behind the price movement. Volume reveals what the composite operator is actually doing while the public is distracted by what prices are doing. You see, price can be manipulated in the short term. The operator can mark prices up or down with relatively modest effort if he chooses. But volume cannot lie. Volume represents actual transactions, real shares changing hands, genuine commitments of capital. When you learn to read volume in relation to price, you gain X-ray vision into the market's true condition. Let me explain the critical volume characteristics that identify high-quality trade setups. First, climactic volume signals turning points. At market bottoms, you will observe selling climaxes, days of extremely heavy volume, accompanied by wide price spreads to the downside, often followed by automatic rallies. This represents panic liquidation, the final capitulation of weak holders. The professional recognizes this as the emotional extreme that marks the end of a decline. All who can be frightened out have been frightened out. The supply has been exhausted. Similarly, at market tops, buying climaxes occur, heavy volume on the upside with increasingly narrow price spreads. This is the public's final enthusiastic rush to buy, providing the liquidity the composite operator needs to distribute his holdings. When you see volume surge but price fails to advance proportionately, understand what is happening. Supply is overwhelming demand at these elevated levels. Second, diminishing volume on tests confirms operator control. After preliminary support has been established, subsequent tests of that support level should occur on progressively lower volume. Why? Because the operator has already absorbed the available supply. When price returns to test support again, there are fewer sellers. They have already sold. If volume continues to diminish on each test, you know with certainty that the operator is in control, that accumulation is progressing properly. This is one of the most reliable signs you can observe. A stock that tests support on 1/3 or 1/2 the volume of the previous test is telling you something definitive. Selling pressure is exhausted. The setup is maturing. Third, volume behavior during rallies reveals strength or weakness. During accumulation, rallies should show increasing volume and widening price spreads. This demonstrates demand is overcoming supply. But during distribution, rallies begin to show narrowing spreads despite heavy volume. The stock labors upward. It requires more and more effort to produce less and less result. This is weakness masquerading as strength. Pay particular attention to what I call churning, heavy volume with minimal price progress. When a stock churns near the top of a trading range after an advance, distribution is occurring. The operator is finding willing buyers and transferring his inventory to them. The volume confirms the transfer. The lack of upward progress confirms it is distribution, not accumulation. Finally, breakouts must be confirmed by volume. A genuine sign of strength breaking out from accumulation should show expanding volume. This proves demand is real and sufficient to overcome all resistance. But if a breakout occurs on light volume, be suspicious. True institutional buying creates unmistakable volume signatures. The tape records everything. Master volume analysis, and you will never be fooled by deceptive price action again. Gentlemen, we have covered considerable ground today, but let me bring these principles together into a cohesive understanding that will transform how you approach the markets. The hidden truth about high-quality trade setups is this: they are not hidden at all. They are in plain sight, recorded on the tape every single day. What makes them hidden is that the majority of traders do not know what they are looking for. They chase price movements, follow tips, react to news, and wonder why consistent success eludes them. But you now possess a different framework. You understand that effort must produce result, and when it doesn't, the composite operator is revealing his presence. You recognize that springs and upthrusts are not failures of support and resistance, but deliberate terminal shakeouts that create the highest probability entries. You know that patience during the cause building phase positions you for profits during the effect, rather than chasing moves already underway. You have learned that context determines meaning. The same pattern signifies opportunity in one phase and danger in another. And most importantly, you understand that volume precedes price, that the tape never lies, and that climactic volume, diminishing volume on tests, and churning action reveal the operator's true intentions behind the price facade. These are not theories or hunches. These are observable facts, verifiable on any chart in any market at any time. The composite operator must leave footprints. He cannot accumulate or distribute substantial positions without creating volume. He cannot shake out weak holders without price action. He cannot hide his campaign from those trained to observe. Your task now is to apply these principles with discipline and patience. Do not force trades. Wait for the setup to come to you with all the proper characteristics in place. When you see accumulation completing, when the spring has shaken out the last weak holders, when signs of strength confirm the operator is beginning his markup campaign, then, and only then, do you commit your capital. You are no longer gambling. You are no longer guessing. You are reading the market's own language and positioning yourself alongside the professional interests who move real money. This is the path to consistent success in speculation, not through prediction, but through observation, not through hope, but through evidence, not against the composite operator, but with him. The market will always reward those who do their homework, who think clearly, and who have the courage to act on their convictions when the evidence is clear. Study the tape. Master these principles, and you will discover that high-quality setups reveal themselves to you with remarkable regularity. The truth was never hidden. You simply needed to learn where to look.